My name is Keith Taylor. I'm the Chief Investment Officer at One Investment. And today I'm proud to have our investment manager for the One Equity portfolio, Guardian Capital, here to present on the portfolio, to give you a background about their investment style, their investment approach, the current circumstances and outlook. So they're going to give a presentation. We'll call it roughly about 30 minutes. To give you a bit of background on the mandate, and then we'll open it up for questions and answers. So without further ado, I'd like to turn it over to Guardian Capital. Again, Guardian Capital has been managing this mandate since 2007. They've had some pretty spectacular returns. Over the last year, equity markets have been on fire, and in a good way, I should say. And yeah, the performance, I think, to everyone that's invested, I think that most people would be happy over the last 12 to 18 months with the way markets have responded. And to give, to elaborate more on what they do, what they have been doing, and their outlook going forward, I'll turn it over to Brian Holland from Guardian Capital to introduce his team and start the presentation. Brian?
Well, good morning, everyone. It's good to be here and to spend some time with you to talk about the portfolio. As Keith mentioned, we've been managing this portfolio since 2007. What we hope to do today is to walk you through, as Keith mentioned, some of the basics in terms of what the strategy is, our philosophy, our process, and then a little update you on the activities in the portfolio and some of the names, and we hope to end it off with a bit of a roundtable discussion in terms of the portfolio itself, and some of an example of an ESG engagement that we've conducted with one of our holdings. For those that don't know Guardian Capital, we were founded in 1962, and we believe we're one of the oldest and still independent investment management companies in Canada. We manage portfolios for clients like the One Portfolio and others across Canada and indeed around the world in a variety of asset classes. To date, we manage about $50 billion in total client assets. On the call with me today is Ted Macklin. You can see this actually on the next slide. Ted Macklin, Sam Baldwin, and Joel Huron. Ted is the newly appointed head of our team. You can see here on this slide that we are a fundamentally based investment management firm. So we conduct a lot of person-to-person meetings with the companies that we're investing in. As you can see here, we conduct about 700 company meetings a year. These are meetings where we're meeting with the CEO or the chief financial officer or operating individuals of the companies that we own to try to get a sense of how the firm is conducting their affairs. And we combine these discussions with our due diligence and research on the company in terms of their financial work, their business enterprise, and their plans going forward. You can see here on page 3 the bios of each of the team members that we're going to be talking to today. I won't go through this, but I'll leave it to you for your leisure to review. But come very well qualified and a lot of experience in managing portfolios. So on this page here, it just gives you a bit of a schematic of our style. I'm going to turn it over to Sam Baldwin, who's going to discuss this in a little bit more detail. Sam?
Thanks, Brian, and it's great to see everybody. So as you may be aware, the way that we hope to generate outperformance and steady returns over market cycles is by investing in high quality stocks. And by high quality, we're going to go into more detail what we mean. We're really looking for attributes of companies that are persistent and lead to lower volatility of fundamentals and lower volatility of the price of the stocks. And this bears positive results in the overall experience of being invested in the fund. The other thing that's interesting about the stickiness of high quality attributes is, other than smoothing the cycle, which leads to a more comfortable ride during the cycle. It leads to longer term holding periods for companies. And Brian mentioned that we would talk about an engagement that we had with companies. We're talking to companies all the time, and we own these companies for long periods of time. So we have long holding period and low turnover in the portfolio. So we get to know our companies quite well. And this would contrast with some other styles out in the market where they pursue either the highest growth companies at a point in time or the cheapest companies at a point in time. And you're constantly needing to find replacements in the portfolio for stocks that have those more volatile attributes. So this is a lower volatility portfolio with long holding periods, and we know our companies well. Now on the next page, you go into what we mean by high quality. And the four main attributes are laid out here. We want to see long-term runway for growth in our companies. We want them to be in industries that are well structured to support profitable growth. So some of our companies are in lower growth industries, but they do mergers and acquisitions to grow a bit faster. And some of them grow organically, meaning just through pure year-to-year execution in the business to achieve their healthy growth. And most have a blend of both. And the profitability in the top right corner really speaks to the companies that we own. We want to perform in all market conditions. And so what we mean by this is, as cycles are inevitable, when a high quality company goes into a downturn in the economy, we want it to be able to come out stronger on the other side. And so this typically means that they'll have a lower cost of operations. They'll be advantaged relative to their peer group companies, such that they'll be able to take market share when conditions are adverse. And we see that with quite a few of our companies now. They're actually better positioned relative to their peer group companies today than they were pre-pandemic. We can go into examples of that later. Thirdly, having a stable risk profile is very important. And we only just need to look back over the past couple of years to see why. The last thing we want to be doing is having to sell a name at an adverse time in the cycle, or indeed, the best time to have low risk stocks in the portfolio is when things are adverse, because A, we're able to take advantage of the downturn conditions to come out the other side stronger, as I just mentioned, but also you, our clients, can feel comforted that you have a high quality portfolio. And when there's higher volatility in the market, you can rest assured that these are the types of companies that you don't need to be nervous about. So you're able to stay invested through adverse periods. Last but not least, the stewardship really speaks to if a company has a good growth opportunity and is generating cash through the cycle and has a low risk balance sheet starting point, then the management and the board of directors of that company, what we call here the stewardship of the company, can very effectively allocate capital that's generated in the business to grow for many years to come. And this is what leads to long-term compounding of capital and good results in the long term. And we also focus in this piece on the ESG attributes of a business. So this would cover everything from how forward-looking they are in terms of their capital allocation. Are they taking things like climate change and emissions reduction and future carbon pricing into account when they allocate capital today? And as Brian mentioned, we do engage with our companies on a regular basis to track how they're doing and to convey what we think are important considerations for the future. So if we wrap up all these dynamics, then we tend to get those companies that produce a good shareholder return over time.
Thanks, Sam. So with that as a backdrop, I wanted to spend a quick minute to describe really what this portfolio is and how it's structured. So when we created this portfolio many years ago now, the idea was to target lower absolute risk, lower volatility. There's many ways to manage a portfolio, as you can appreciate. And one of the things that we decided to do was to target this lower volatility over trying to target the portfolio relative to the benchmark. So one of the key ways we do this, and when we looked at constructing the portfolio, what is the major source of volatility in the Canadian marketplace? Well, as you may know and may guess, it's the resources. So energy and materials is a huge area of volatility in the Canadian marketplace. And if you look back in time, it's actually been one of the larger areas as well. So unlike other parts of the world, if you look at the global markets, for example, the Canadian market has a great deal of exposure to these resources. So what we did when we constructed this portfolio is to say, look, why don't we take a more of a global view? We'll be investing in Canadian companies, but what if we were to invest in more of a global sense and have exposure to energy and materials, but not as much as the index would lead us to invest in. So that's what happens in this portfolio, and I'll show you a graphic on this in a second. So we have some energy and materials in the portfolio, but not as much, and it's led to lower volatility, lower risk. But one of the things that doesn't cause it to do is it performs differently than the market itself. We call that tracking error. So it has a higher tracking error. So in other words, it doesn't match the TSX as closely as it would if it was a core portfolio or an index portfolio. You can see here that we hold 35 to 50 stocks in the portfolio and 8 of 11 sectors. So it's a very well diversified portfolio overall. So if you look at the next slide, you'll see that the allocation to the combined weight of energy and materials is relatively low, not zero. There's some exposure, but a lot less than you see in the index in that dotted blue line. It's interesting, actually, if you look back into the 2008, 2009 period, how high, most people don't even realize this, but half of the index at that time was in the resources. That's a huge area of volatility. So we felt it was important to have some, but not as much as the index would guide us to invest in. The other part of this is that, and I'll get Sam to jump in here to talk about the merits of energy materials as a group. Do they even deserve, from an investment perspective, to have a 50% weight? Sam, do you want to have a few comments on that?
Absolutely. So if the point of the portfolio is to provide good exposure to the equity market opportunities and have outperformance with below market risk over the long term, we want to tilt the portfolio, not just as I mentioned earlier, towards quality stocks, which generally would provide outperformance with below market risk, but also towards the highest quality within that subset. So what we mean by this is, if we look at extractive industries, by definition, they're constantly needing to replace their reserves. So when they generate cash flow, a large proportion of that cash has to go back into exploring and creating the future capacity to keep digging, so to speak. And through the cycle, these businesses tend to generate less returns on the capital that they invest than companies that don't have that natural decline rate. And so by de-emphasizing resources, we're lowering volatility because it's a higher volatility part of the market, but we're also exposing the portfolio to more superior economics of the business models. And so whether it's consumer companies or financial companies or other pockets of the portfolio, we tend to have higher returns on the invested capital on those investments that we took from what we didn't invest in resources. And so it blends up the returns over time of the portfolio at the same time as reducing risk. Brian, I can elaborate in any fashion you wish, but that's, I think, the main point here.
And I think if you look at the next slide, you'll see, thank you, Sam, you'll see that the outcome has been quite favorable. If you look at the right-hand side, first of all, I should explain what we're looking at here. This is a survey from the Mercer survey of all investment managers in Canada managing Canadian equities. This is an institutional survey, and what you should understand is that this is an apples to apples comparison. So what we're looking at is before fees, so a gross of fee return. So you can really see the abilities of managers showing through here. And the blue box you see, the rectangle, that is the range of returns that's available in that time period. And in this analysis, we're looking at a 10-year time horizon. And you can see here in the blue square, that's the one portfolio. So what it's saying, and looking at the right-hand side, it's basically it's the number one performing portfolio over that 10-year period. And you can see the data on the bottom. It's actually ranked as 0. Now moving over to the next column, we see where it says down cap. This is down market capture. And what this is referring to is how the portfolio performs in falling markets. And so it's more virtuous to have a lower number. And you can see here that we're right at the bottom of the sample. So what it's saying is that the portfolio, while it has the highest return over this 10-year period, it has the best experience, that is, loses less than the average portfolio in falling markets. And I'll show you a graphic on that in a second. And then moving over to the next column over, where it says STD DEV, that's the standard deviation. This is another measure we use for risk, and it basically measures the volatility of the returns. And so as if the portfolio is more volatile, you'll have a higher number. And in this case, you can see here, we're at the very bottom of the sample. So again, it's more virtuous to have a lower risk or lower volatility, more predictable nature of the portfolio. And then finally, the column on the left-hand side, this is called tracking error. That's what I was referring to earlier. And it measures how different you are from the index. So if you, for example, if you look on this far column, you'll see right at the bottom there, a line with a 0. That's the index level. So the index itself, if you were investing just in every security in index, an index portfolio, you would have a tracking error of 0. So again, the blue rectangle represents the range of tracking error in the marketplace. So you can see here, we're near the top of the sample, which makes sense. If we're trying to beat the index, we have to be different than the index, and that causes us to have performance that is different from the final outcome. And you'll actually see that when Joel goes through in a minute, the performance with energy doing very well recently, the portfolio has a lower weight in energy, and that has played against the relative returns in the near term. But as Sam was mentioning earlier, we think that by deploying some of those assets to other parts of the market, it provides better returns in the longer term. This is a schematic. You may have seen this in other illustrations. Basically, it measures the risk versus the return. And again, the portfolio is shown in that blue square. And so what you're getting is this over a 10-year period, more return but less risk than the market, is shown by the 0 mark there, or our competitors in this asset class. This is showing the year-by-year performance of the portfolio. And what we've highlighted here is periods where the market is down. And you'll see very consistently that the portfolio, it does go down. I mean, we are still subject to the market forces that push things down, but we don't go down as far, and we tend to recover faster. And this has been pretty consistent through time. And if you look at the final couple of slides here in terms of the outcome, on the next slide, this is again that same Mercer survey. And if you look at the relative performance versus others in different periods, you'll see very, very strong performance over the 5, 10 years and longer term history. You'll also note in the more near term that the performance is a little bit weaker than the benchmark, and a little bit weaker than the others. And we're going to talk a little bit about that a little bit more detail. But the main headline is that an underweight in energy systematically in a period where energy is doing very, very well has hurt the relative performance. But when you think of how strong energy has been, we've actually kept up quite well, and again, without any of the risk that the market has shown. If you look at the next slide, you'll see that we're showing here the year by year, the calendar year performance. And again, it's another illustration of how the portfolio performs in falling markets. If you look at the blue triangles in the periods where the market was weak, so 2011, 2015, 2018, it shows you the periods where the markets were down, and it's going to happen. We're not sure when the next one is going to happen, but it happens periodically. And you can see that we significantly outperformed during those periods. And that's what we want to have is to help preserve the capital of the portfolio. Finally, in the next slide for my section, you'll see the actual numbers. I won't go through this in detail. I'll leave it to you to look at when you look at the portfolio afterwards, but we're showing the longer term results. I've also included here the prudent investor portfolio, which has been created the last couple of years, and you can see the results very, very similar to what's going on with the legal list portfolio. So with that, I'm going to turn it over to Sam. He's going to walk us through our current thinking in terms of what's going on with the portfolio and some of the market forces. Sam?
Thanks, Brian. And I'll start off on this and then pass it to Joel to discuss more detail on some of the individual names, just to provide color. Brian discussed the long-term performance of the strategy and how favorable it's been. And when you go back and look at that previous page, not now, but for your reference, you'll see that the outperformance in down markets is consistent with the picture that Brian painted in that section of performance slides. Now, in a year that's as strong as we've had year to date, with the leadership we've had being energy being a big part of it, it's positive in our view that the portfolio has been able to keep up, but with a lag as expected. So in some sense, it's doing what it says in the tin. But we'd probably provide a bit of color on some of what we see as being the maturing nature of the current cycle that we're in. Now, of course, we had a huge rebound, almost like a slingshot, from the March 2020 period in the depths of COVID. And as time has passed and the vaccine announcements came, the nature of the cycle has matured to reveal glitches and what we call frictions in the operations of the global economy. And you and we read about this every day in the newspaper, but we put a few bullet points here. It's really the second bullet point here that has 4 factors that we've identified that have really been rubbing on company performance year to date. And one of them is input cost inflation. And so we've seen everything from agricultural commodities to oil prices and gasoline prices, which impact transportation costs, becoming elevated this year. And these costs at first will tend to shrink a company's profitability, because when your costs go up and your revenues haven't, then you have a bit of a squeeze. But what happens is the companies that we invest in are typically leaders in their industries. They will take prices higher to offset those increased costs. And we're seeing that alleviation of the friction of higher input costs has produced benefits in the most recent reporting quarter that we just went through. So these have been headwinds year to date that are starting to abate in that type of area. Labor scarcity has been all over the headlines, and you can see it when you go into restaurants that are understaffed. Particular problem in the United States, where there were particularly generous COVID benefits relative to the wages that were being earned in certain industries, especially. And so at the beginning of the pandemic, it was people being absent due to COVID itself. And later on, it became just the demand side of the economy being stronger than the supply side on the labor front. So that over time will work itself out as some of the benefits go away and people get back to work. But that's something that has reduced the productive capacity of some companies in the economy. And certainly pockets of the portfolio could be doing better if they had better access to labor. And we expect that to be alleviated as well. The third real friction that we've seen is supply chain constraints. We see this famously with the semiconductor shortage in the automobile industry. There's a lot of half-finished cars that need chips before they can be sent off the lot. That's being alleviated, particularly in Asia, where a lot of the chip making and assembly comes from. we'll see that start to flow through, but that's been a bit of a headwind for results. And then last but not least, mobility limitations, twofold really. One is there's less travel and less concerts than, one of the holdings, Gildan Activewear, which makes t-shirts. They're going to sell fewer concert t-shirts, for example. So mobility being not yet where it was pre-pandemic, there's some degree of loss of business. But there's a second order effect, which is that companies that we own in the portfolio on your behalf are normal acquirers of other businesses. And typically, if you want to acquire a company in your industry, you have to travel to the areas where they operate, view the factories, kick the tires, so to speak, and then make a decision. And if you are satisfied that you have the information and a positive view on the acquisition potential, then you can buy that company. If you don't travel, and if you're not able to travel, then it's more difficult to do that. So that driver of company performance has been relatively absent until recently, and that's starting to come back as well. So year to date, I think that if you add up these factors, we've seen some headwinds in addition to the things that we own less of in the market, for example, energy Brian mentioned, and Shopify as well. But we think that some of these headwinds are going to be turning into tailwinds. We put this slide in here. It's a holding within the portfolio. It's actually within the energy part. There's quite often situations where we have a view on the potential for a stock and have a view that essentially a positive future is not priced in currently. And we had that view with Cameco, which is the world's largest listed producer of uranium. And the supply-demand fundamentals for that commodity were in a funk after the Fukushima accident, but many years into the aftermath, to us, it looked quite clear that there was going to be not enough supply for the amount of demand that we were going to see. And so we've owned this position for about 5 or so years. And just looking at this 5-year chart, you can see that it took a lot of patience in the first 2/3 of that time period, but then it's performed very well. So this is to say that all the examples that Joel will talk about that are currently experiencing frictions but have very solid fundamental underpinnings sometimes require patience to see that come and bear fruit. But we see that coming through with names in the portfolio, and we expect to see more of that. Joel?
Thanks, Sam. So on the next slide, what we really wanted to demonstrate, as Sam mentioned, was there are a lot of these positions that we have very high conviction in, but that have been impacted by some of these frictions. So a couple that I'll flag, just on the theme of acquisitions that Sam just talked through a couple of slides ago. These are names that have very strong balance sheets, a lot of cash to deploy, and have historically grown both organically, but also through acquiring businesses in related industries. And we've seen over the past several months, some of these companies actually start to travel again, start to do diligence on assets. And the market has rewarded the names that have been able to put that cash to work and start to grow through acquisition again. So that's kind of the first area that we're starting to see these frictions come off, and that's reflecting positively. But we wanted to dig a little bit more into 2 names that have been impacted by several different frictions, just to give you a bit of a taste for what we're seeing in the portfolio, and also how companies are dealing with these frictions. So the first is Maple Leaf Foods. Maple Leaf Foods is a producer of chicken, so poultry, pork through pigs, and also plant-based protein. So both meat mimicry, if you think of a plant-based hamburger, but also some alternative proteins like a tempeh, which is a soy-based protein. So that business overall has been growing tremendously over the past few years. And it's also seen its profitability improve overall as they've invested in things like automation in some of their operations. But more recently, through the pandemic, they've been really hit on from several different angles. One would be input cost inflation, so things like feedstock for pork and poultry, that has seen dramatic cost increases, and the company has to absorb those. Now, positively, if you look at offsetting that, the company does pass through price increases to grocery stores, but they operate at a lag. So it typically takes about a quarter, so about 3 months for that price increase to take effect. And so, of course, that impacts the profitability of the company shorter term. Some other things that we're seeing from a COVID friction standpoint at a Maple Leaf would be on the access to labor. There is still a fair amount of labor required for the manufacturing process. And as Sam mentioned, specifically in the US, we are seeing challenges when it comes to companies hiring and retaining workers, but also those companies having to pay more to retain that talent. So these are all elements that are impacting the company near term, but longer term, we have extremely high conviction in the business. If you look at the right hand of that chart there in the middle, which is Maple Leaf, you can see their most recent quarter when they provided an improved profitability outlook. The stock was well rewarded in the market, which we were quite pleased with. So these are all things that we're seeing in the portfolio with high conviction positions. And as the frictions start to abate, we believe that the improved fundamentals will really start to shine. The other one that we wanted to discuss and mention quite briefly is Element Fleet. Element Fleet, as you may guess by the name, is a fleet management business. So basically what they do is they procure and then service vehicles for large corporate fleets. Now, if you were to think about your the Rogers or Bell technician fleet, or even a government fleet, that would be something where Element would handle that business. So very large fleets. The business has been growing significantly over the past several years. It's seen really improved returns on the asset base that they have. And so they've turned around the business essentially. And it's really driven by a reduction or a desire for businesses to reduce complexity and outsource some of that requirement. And Element steps in there and does that. But on the friction side, I'm sure a lot of you have read about supply chain issues impacting semiconductors. And given cars have quite a lot of semiconductors in them, there's been production shortages of vehicles. So Element's essentially been growing its business through the pandemic. They have a backlog of deliveries that takes us all the way to late 2023 or early 2024 at this point, but they just can't get the cars yet. So we're very constructive on the business because we have fantastic visibility into that growth that's already contractually obligated growth, which is very positive. But we're just waiting for those vehicles to come through. So I think with that, I'll flip to the next slide, but we just wanted to give you a little bit of color into what we're seeing in the portfolio, the high conviction positions, and the amount of time that we spent with some of the holding companies through the pandemic to really understand how they're positioned. So what this next chart is portfolio attribution. What this shows is how the strategies performed versus the index. And what's interesting is if you look at allocation basically describes whether or not we are under or overweight versus the index. So for example, if you look at energy, as Brian and Sam discussed, we are underweight energy. We have a smaller weight in energy than the index. And so since that has performed very well this year, you can see some negative numbers there. That has hurt our performance versus the index. To no surprise, this is exactly what we would expect in a period of strong energy. The other thing that's worth mentioning here is in the information technology sector. So Shopify is a name that has been very strong. It's Canada's largest business by market cap on the TSX. And it's performed very well for the index. Well, we do have a holding in Shopify, but versus the index, we are about half of that. And so what that means is as Shopify performs very well, we do face headwinds. So we do get some performance from that, but versus the index, we are hurt a little bit from a performance standpoint. The only other thing that I would mention here is a friction that shows up in the numbers, and that would be on Saputo. Saputo is a dairy manufacturer. So they manufacture cheese and milk globally. So they have operations in the UK, Australia, North America and Argentina. But they've again been impacted by things like labor constraints, supply chain constraints, and transportation costs. And so that directly shows up in the numbers. But I think with those three things combined with the discussion that we've had on frictions, it's probably worth moving on just to touch briefly on some transactions. So I think Q3 is a very similar story to the broader year in terms of what we've seen. So we can skip this slide. And this slide highlights some of our top and bottom contributors, which we can come back to in the Q&A if necessary. Yeah, this is the slide I'd like to quickly talk to. So this is a very low turnover portfolio, as Sam mentioned in the beginning of the presentation. Typically in a quarter, we would have 1 or 2 names in and 1 or 2 names out. And you can see that shows up here. And we'd sell names for a variety of reasons. It could be because a stock breaches our valuation threshold, so it's performed well, the thesis is played out, and we decide to exit it. It could also be for something like a quality downgrade, where we've seen heightened element of risk and a reduction in quality, as Sam mentioned when he walked through that wheel earlier. And that was the case, one of our sales at the beginning of this year, Couche-Tard, which is a convenience and gas store operator. We sold that as we saw a heightened risk or quality downgrade in that business. But I think with that, what's best to do now is to pass it off to Ted, where he'll just make some comments on the broader portfolio.
Thanks, Connie, Joel. Yeah, you can see on slide 21 here that this is a high quality, prudently diversified and structured portfolio with the names. Both Sam and Joel have gone through a lot of the detail here. And what I would highlight is going back to some of Sam's comments that we've reduced the volatility of the strategy by reducing the resources, which, as Sam mentioned, are typically the areas of the marketplace that have a lower return on invested capital when you go across the cycle, and that results in better stability in the returns for the portfolio. A couple of things that I'm going to let Brian maybe pipe in as well at one point, but I think what I'll talk about is going back to the theme of quality here. We want to emphasize if a company demonstrates a deterioration in quality, then we will eliminate that name from the portfolio. And we're not averse to doing that, no matter how big the name may be. If you go back to past cycles where you have dominance in the marketplace, Valiant was a name that was a darling of the investment community for the longest time. We never owned a share of Valiant at Guardian Capital, and in particular in the one portfolio. There were some relative headwinds at times, but it didn't meet our quality metrics. And that served our clients very, very well, having an emphasis on quality. The other thing I would highlight for you more recently, because it is topical in the media, would be with Rogers Communications. And this is an example where when the transaction, the merger between Rogers Communications and Shaw Communications was first announced last spring, strategically, it's a very logical transaction to take place. But there were things that we were uncomfortable with the transaction, in particular the high debt levels and some integration risk for the two companies. So we immediately started to de-risk our position by reducing the position within your portfolio. And this was long before any of the headlines hit the press on the family drama that you've no doubt read about. It was a small position in the portfolio. You can see here at 1.8% as of the end of September, and we quickly went to 1% and 0 because simply going back to that quality wheel that Sam talked about with the talking about stewardship and the financial risk. There were several factors here that started to really unravel or detract from our confidence in the company. And it has been sold from the portfolio, which is consistent with our long-term emphasis on holding quality names in the portfolio. We also believe it's a tremendous opportunity for both BCE and in particular TELUS to be able to leverage their business models while Rogers Communications is arguably distracted between some of the boardroom dynamics in addition and management dynamics, in addition to trying to integrate the acquisition, which will also be in the wake of or the face of some regulatory uncertainty. So with that, I think I'm going to bring back in maybe Sam has got a couple more things to comment on here, and then Joel as well. Sam?
Thanks, Ted. Well, one of the things that would be a good opportunity to discuss here and is generally a topic that we talk with clients about on a regular basis relates to ESG. So for those less familiar, ESG really speaks to factors that are non-financial in the classical sense of the word, although they impact long-term financials and strategic outlook for companies. But E is for environmental, S is for social, and G is for governance factors. So put together, ESG is gaining a significant amount of attention as the focus goes from just pure financials driving stock price performance maybe 10 years ago to maybe the next 5 years, where it's going to be very much a blend of forward-looking capital allocation decisions based on these types of metrics. And so one of the examples that we thought would be worth sharing with you is our engagement recently with a company called Suncor, which is one of the big players in the oil sands in Canada. The oil sands is a very significant, and the energy industry generally is a very significant industry in Canada. It's about 10% of GDP. Canada needs to essentially harness its resources, but in a clean way, while driving emissions down to be moving forward as a modern economy during the energy transition. And so our focus with Suncor, other than a update at the beginning of the meeting, and this is with the CEO of the company, to get a business update on the operations, which are going well, and the operations are running smoothly, is really how do they approach capital allocation during the energy transition? There are a lot of variables to think about, not least carbon taxes, which are slated to move up every year until 2030 to about $170 a ton, which is world leading. There's also the potential for the government to accelerate investments in energy transition areas for oil companies and other pockets of the economy. And so really we talked with the CEO about how those discussions are going for the federal government in particular, but also provinces, to create the right incentive framework for investment in the energy transition for companies like Suncor, which are enjoying strong cash flows and essentially have very concentrated operations. One of the interesting tidbits that was shared with us is that in both their major base plant operation as well as Syncrude, which is those very large area operations with smokestacks, all those smokestacks are within 800 meters of each other. And so with the right incentives, Suncor could quite quickly invest in carbon capture projects to take the right amount of carbon out that would then be sequestered and transported into storage. And these sort of carbon sequestration projects are a little bit like renewables, say 15 years ago, where the economics wasn't quite on par with other sources of energy. Carbon capture projects on a per ton basis are still quite expensive, but if a lot more R&D and investment is put into these areas, then the costs could come down and they could become quite economic. So essentially we talked with the company about what's the prospect for, right now they've got about 10% of their annual capital budget targeted towards energy transition investments, how that might move higher if the right investment framework were put in place. and they're quite encouraged with their discussions with government. We'll see how the announcements come, but the company is in a great position with a broad portfolio of projects to very significantly reduce emissions, and the potential for emissions reduction, of course, extends beyond them to the entire industry. And being one of the larger emitting industries in Canada and having these pathways to dramatically lowering emissions really takes the country a long way towards its goal of moving towards net zero. And Suncor itself has even put a net zero commitment by 2050 to investors and other stakeholders and to government. And actually, the industry is the only industry in Canada that actually has a plan to get to net zero by 2050. So there are a lot of things, despite being a dirty, let's say, company and a dirty industry, that can be done and that already are being done by these companies to reduce emissions. And so we think that one of the things as an ESG investor that we can do is to invest in companies that already have very clean energy, pro ESG attributes. We can think about companies that very much have a light carbon footprint, for example. But it's also important to, subject to being a good prospective investment on all these traditional metrics, but as well as these discussions, to be invested in companies that have a rapidly improving ESG profile. Because if we look 5 years from now, back on today and investment decisions we're making, where companies' decisions today are actually dramatically reducing the outlook for emissions, then we're seeing the potential to capture rapid improvement, which could lead to much higher valuations, because these types of companies are very much in the penalty box today. So I'll sum it up there just by saying that we're constantly engaging with the businesses we own on your behalf. And we're obviously trying to select companies that will outperform financially, but also trying to select companies that have the right mindset and operational and strategic frameworks to be capturing the opportunities presented by changes on the ESG front as well. And maybe I'll pause there.
Perhaps we'll end our formal comments at this point and open it up. There was one question from the in the Q&A notes about what happens with new capital that's contributed to the portfolio. How do we invest that money? Do we invest it in new securities and what have you? And the answer is that the way we manage the portfolio, it's based on a strategy basis. So it really is independent of how much money is in the portfolio, whether money is coming in or money is coming out. So if you were to contribute money to the portfolio, what would happen is that we would basically invest it in all the same securities that is in the portfolio today. Similarly, if a withdrawal is made, we basically take a slice of the portfolio, sell a little bit off of all of our positions, and raise the capital to meet your withdrawal request. So the idea here is that when we manage the portfolio, the team is focused on what is the right securities, what is the right combination and weighting of those securities that will provide the most optimal risk and return balance in the portfolio. So it really is independent of the cash that is coming in and out of the portfolio. I hope that answers the question. So we'll open it up now if there's other thoughts or questions from the people on the call.
Well, the question I keep getting from a number of investors is, what should we be doing? Interest rates are low and likely to go up, bad for fixed income returns. Equity markets have been spectacular over the last 12 months. Is it going to persist? What do we do with our money? And maybe I'll just, as always, ask Ted and team to pull out the crystal ball and tell us, in the current environment where, inflation's upticking, interest rates may go up. What's your short to medium term outlook for the market? Is it a bad time to be in equities? Is the question I get.
My opening remark here is on that crystal ball, Keith. I do anything to have that crystal ball. Have not been able to figure out how to source that. I even looked on Amazon. But to be quite serious, what Guardian's always done is to construct portfolios that should perform through most macro environments. And this is our bottom-up process with high quality stocks, as we've talked about. And the companies that we're investing in are well positioned. So that if we I mean, sure, we have a macro view. Sam and I can give you some context on that. But if that macro view doesn't play out, our companies still perform well. And that goes back to the earlier slides that Sam talked about at the start of this discussion, this webinar. So we're constructing portfolios that should perform well through most macro environments with high quality companies. And on that crystal ball, as far as whether or not inflation is transitory or sustained, the rising rate environment and the causes of it, I'm going to let Sam talk a little bit more about that crystal ball that he may have sourced overnight on Amazon.
Well, Ted was asking me this morning, where did his crystal ball go? He usually keeps it under his desk, and I had to hide it when he was starting to sniff around my office. But no, more seriously, what Ted said about being able to structure a portfolio to invest in most market conditions is really paramount. And, we only have to go back 2 years, 5 years, however many years, but especially the recent period to say that unexpected things do happen. So the ability to absorb shocks and really, I guess what I said right after Brian finished talking about the performance section about the downside protection, credentials in the portfolio are very strong, meaning that when the index is going down, the outperformance of this portfolio is quite often the greatest. And you combine that with the ability to move up with up markets. And in the very, very strong up markets, often with a lag like we've just had, the smoother ride and the general out compounding of the market is the result. Now, it is a long-term orientation with the result, but the math works out that if you go down less and then essentially keep up when things are rising, that's an outperforming strategy with less volatility. So as far as interest rates, and transitory inflation and the like are concerned, really what we've seen is an unprecedented boost in the goods side of the economy at the expense of the services side of the economy. So as people have been, early on, I guess, at stay-at-home orders, but even still, like a lot less travel as a percentage of your total spending versus spending on stuff. Each time we buy stuff, quite often there's material demand for that. The inputs and the goods that go into intermediate goods that go into making final goods become in relatively short supply. So I guess the key thing to determine would be to what degree can the supply side of the economy catch up with the demand, or will demand cool off in some areas? So a few things to say on that. In the demand side, we see demand cooling off in some areas where there's been a lot of pricing growth. So for example, in the housing market, there's a combination of it's harder to find some of the intermediate goods, doorknobs, for example, but also the pricing on things like lumber were very strong last year. And so consumers temporarily backed off. Now there's a good long-term picture there. So that would be a tailwind for companies in your portfolio like West Fraser Timber, which is a lumber producer. And so we see demand cool off in areas where pricing gets ahead of itself quite often. And so things tend to normalize. What we've seen is that goods are normalizing at a higher level, which feels like inflation. But I guess what markets are looking forward at are, to what degree will inflation keep rising at the same rate? So we could have to live with the high prices that we're currently seeing. But if they don't keep rising at the same rate, then that's called falling inflation. So for asset prices, it's important to see falling inflation, i.e. Not too hot, not too cold. Certainly, we don't want to see a recession, but if growth cools, then that would be generally supportive, and we're seeing that. to some degree, but demand is still outstripping the supply side of the economy. So as the supply side, whether it's semiconductors or housing inputs, normalize and respond to the increased demand, we may see some of the demand cool off as some of the spending moves to services, say travel and other things as well. So it's very difficult to predict. What was the quote? Yogi Berra made a quote. It's very difficult to make predictions, especially about the future. And so we just want to have great companies in the portfolio that if there is inflation can pass it on and preserve margins and don't have financial vulnerability if interest rates go up. But if the market gets more rocky here because growth is slowing and interest rates are firm, we think we've got the right portfolio to navigate in that environment. So that's not really a crystal ball comment, but it's a little bit of color on the puts and takes and how the economy's working its way through this period.
That's perfect. Yeah, I just like to try to put you on the spot. You know, I know that you know, crystal ball bit is not your full-time job. There was one comment here or one question that came up in the Q&A, and I'll just share it. They noted that they like these type of updates. They enjoy the feedback and a sense of what's going on in the portfolio. How do we do this frequently? That kind of a bit. And at One Investment, I will say that we have been trying to do updates similar to this twice a year with our managers. So there is an opportunity for the municipal clients to understand what the managers are doing with the portfolios and to get some background. So if they need to share the insight with their counsel, they've got that at fingertip. So we do intend to do this twice a year. Last year we did one in the spring that was it was more targeted on a specific topic, but yes, we are available to provide feedback if there's specific questions or items that you want background on. Don't be afraid to send One Investment an email, and we will reach out to the folks at Guardian Capital, and we'll get a response back to you. So if you have some discomfort about a particular holding or the outlook, whatever, yeah, we'll get you answers as appropriate, and we will try to keep the communication up at least twice a year so you have a chance to ask questions directly from the managers. And with that, I'll just say thank you to the folks from Guardian Capital for being here to share your insight, and we'll close it off until the next time. Thank you very much.
Thank you all.